I didn't realize that actually my television was in HM1, which it should be in HM3. So I had to figure
Still got a
out
couple
that.
minutes.
Okay.
You know, I'm not that,
Come over here, get this thing on.
I was married.
Yes,
You figured it out?
I was married to a
Hi, John.
junkie, so I never had to do any of that stuff. Yeah. Oh yes, I did. It's working.
Who's on the bottom? Oh, yeah, no.
Wait.
Just get back.
Yeah.
I don't think you can see you.
Right.
They can't see you.
Yes, I would.
Which one is John?
I don't know.
And Miami too.
I
Yeah,
think he's covered up.
Is John sick?
no, they won't.
Oh, that's Roger.
He said it's going around the office.
Yeah, Florida baseball.
Anybody need a mask? I have some.
Maybe I'll lose weight.
They don't work.
There's a lining to everything.
Oh my
Come
God.
on, Ann.
I have tons of them.
I know, but there's one clean one right there.
You know, I actually flew with my mask the last time.
Okay,
And I was not sick after I got home. Chris needs a big
John, say
mask.
something now.
Whoa, he sounds like shit.
Okay.
Did I say that out loud?
I think that,
Is there anybody besides John West on Zoom? I mean, that's a board member.
John West.
Roger Schultz.
I can see you.
yeah, we can see.
Miller.
I got Roger too.
Gus Miller.
Yeah, I'm sorry, Roger, you mean,
Where's Gus?
I just seen you, so I just wrote
Did
it
you
down.
get Gus Miller?
No, is he on?
Yes.
Where? Or is that
Oh wait,
Jan?
did he just drop? Which one's Gus? I thought he was the bottom right.
No.
You must have,
He must have dropped off.
yeah,
Bathroom.
Tiffany just
Tiffany.
came on.
Okay.
Hi, Tiffany.
Hey, Steve.
Were you not upset about Spectrum stopping the US Open?
Was I not upset?
Yeah.
How could I not be upset?
I flew to Michigan and watched the end of it.
And now we can't even get Nat Geo.
Yeah,
And
my
one other
favorite.
FX, I think.
What?
What was the other one? The renegotiation, they dropped Nat Geo from the channel lineup and National Geographic.
Okay, we all set?
Well, Hot Wheel was going to
Call this meeting to order?
come and do a presentation because they're
Probably.
Recording in progress.
Thanks, Chris. Confirmation of proper notice.
You recording?
Notice posted according to proper requirements.
Thank you, John. John is via the phone. Roll call. You got it? Pretty much.
Pretty much,
I think we got everybody.
everybody that's here.
we got the most important people. How's that?
Yeah, we don't have, Shannon, not here?
No, I don't think he's gonna be
No.
here.
And Gus, not here, unless he come back
He
on.
was.
Yeah, I think he'll be back.
George, no
George. Okay.
I
I think we got everybody.
think that's it.
We got
Here he
everybody
is,
down there,
there's
huh?
Gus.
Oh, Gus is back?
Told you he went to the bathroom.
Where's Gus? Oh, is that Gus? Oh, there he is. All right. Insurance issues. That's what this is all about. John, you want to start?
Well, yes, I mean, as you recall, we've had several discussions concerning the radical rate increases that we're facing and the impact on the owners and the budget. Conversations with our agent, it's kind of agrees to the entire situation. But he has proposed that the board consider lowering the limits of certain aspects of our insurance package, i.e. the wind damage insurance, that could
John.
With the mascot for the board. She's so cute. Thanks. Hey, John, thanks for the preface there. Yeah, so to John's point, I mean, I think everybody is aware, you know, obviously we're in a bit of an insurance crisis in the state of Florida. There's been 2 legislative special sessions over the past year, just specific to insurance. So there's been a lot of legislative reforms that have been passed, which have all been really good and excellent. And I think as time progresses, we're going to see a lot of those legislative reforms take root and the market will slowly improve. We're seeing, I would say, glimmers of hope, kind of like that we're in the early innings of a soft market, but we're not quite there yet. It's just going to take a lot of time because a lot of the Ian claims are still going to be filed for the next year because people had up to 2 years to file a claim after Hurricane Ian, but they changed the law. The new law is 1 year. So there's something that the industry calls loss creep, where they expect a lot of insureds that didn't think they had a claim to be basically solicited by public adjusters, you know, unscrupulous litigation attorneys, people telling you that you're going to get a new roof, etc., for the next year. So carriers now have to reserve for that unanticipated aspect of more claims being filed, more litigation going on, and that's going to kind of gum the system up for at least another year. But I think we're going to get to a better place. I remember at the tail end of the last hard market, we started to see little glimmers of hope like we're seeing now, where new markets were coming into the state, and they were kind of slowly wading into writing certain types of risks, like condos in certain areas, maybe garden-style condos, maybe some newer construction. And then eventually they started sort of loosening up their underwriting guidelines, and they were writing a lot more condos as well. So I do think we're going to get there, but it just doesn't happen overnight. We can't just flip a switch and say, okay, we're going to go from 50 to 100% rate increases last year to net, you know, flat renewals this year. It just doesn't happen that quickly. It's a cyclical cycle, just like any cycle, whether it's the real estate market, the stock market, everything goes up and down. And I think we're at the highest point that we're going to be, and we're going to slowly start to see a gradual return to normalcy. It's just going to take time. So John had mentioned a couple things that we talked about, specifically on loss limits. We've been looking at that as an alternative. It doesn't mean that's something that we have to do. It's just a way for me as the agent that represents the association. It's our job to come up with anything that we can come up with that might be innovative, maybe outside of the box, that could create sort of an economized solution for the association. Now, when I say economized, that means it would be potentially less costly than a full limits option with, for example, the incumbent carrier. However, it comes with a certain degree of risk tolerance as well, right? Because you have to be tolerant of the risk of saying, okay, well, our insurable value is X, whatever, $80+ million here, but you might be procuring a limit for wind that could be $5 or $10 million, meaning that anything over $5 or $10 million in wind damage would be effectively self-insured. So we have a number of clients that have looked at this as an option with associations like you that are spread out, that are, you know, excellent construction type, mostly concrete, masonry construction, and we can look at that as an option upon the renewal. Now, it doesn't mean we're going to do it, but it's something that we're going to explore and present. Now, John mentioned the statute. The statute talks about you have to obtain adequate property insurance is what the law says. Nobody defines what that means. It's an interpretive statement, adequate property insurance. What I think that means could be different than what you think it means, right? So nobody really knows. So you look to your documents, and your documents state that you have to have, you know, the standard coverage is wind, casualty, you know, fire, etc. And then it mentions for the full replacement cost, and it says, or insurable value. So I guess there's a couple interpretive aspects of what you have in your documents that you can kind of decide as a board if you feel that if you wanted to go a loss limit route, and ultimately when you're looking at the numbers when we're talking about the renewal, if the loss limit equates to a few $100,000 less in annual premium, and you want to go that direction, you're going to have to consider obviously what your documents state. You're going to have to consider the risk tolerance level of what you're doing. For example, if we do like a $5 million loss limit and you have a $10 million wind claim, you're going to be eating that additional, you know, self-insurance cost of that. Now, what is the probability of that? Very slim. And we don't just pull these numbers out of thin air. They're not arbitrary. So I work with John. I told John we use industry modeling, right? So the reinsurance industry, the underwriting industry all uses catastrophic models. They're basically software systems that takes all the variables of this property, imports it into a software system, and they run these different models. They call them return periods. So there's a 250, a 500, and a 1,000 return period, which some people will just casually call, oh, like you hear people talk about the 500-year storm. They're actually talking about the 500 return period relative to this catastrophic model. So we've run all of those for this property, and we could probably get away with doing a $5 million loss limit because the probable maximum loss numbers for this property are pretty low. And those numbers represent potential for wind damage and storm surge damage, which is pretty much not going to be happening here. And if we have storm surge here, then we're all in a bad predicament. I mean, Bradenton would probably be wiped out at that point. But I think that's unlikely. So we'll look at those and use those numbers as our basis, so we can't be accused of being arbitrary. If we pick a loss limit of $5 million, someone might say, oh, well, where did that come from? Did you just make that up? Well, no. We have a model that says this is the basis for what we chose to do. And you wouldn't be the first association to do this. We have a number of clients that have done this over the past year since Ian, because the rates have gone so out of control, right? So we'll look at that. And again, this is just one, tool in the toolbox for us to evaluate. We're still going to expect a full limits renewal from American Coastal upon the renewal. Now, we do think that they're going to be probably coming at a minimum 50%, maybe upwards of 70%. That's kind of what American Coastal is doing right now. So we know that's going to be a pretty cost-prohibitive option. We want to have alternatives to look at. That's why we're talking about a loss limit. We'll look at Citizens as well. I don't know if anybody's familiar with Citizens. It's the state market for wind, the state market of last resort, effectively. We got an indication from them last year, and it was significantly more than American Coastal last year. It was well over $1 million in premium. So whether we want to pursue that, there's a lot of work involved. For example, they're going to require you pay for a roof inspection form for every single building here. And those forms are like $400 a piece at best. That's the cheapest one that I've seen that a roofer will do. So you times that by the number of buildings, the number of roofs, it's a lot of money to outlay for an option that you may or may not even go with. So we'll run Citizens again to get a preliminary indication, and if I feel that it's going to be worth our while to pursue it, I'll recommend that we do. The one thing to note as well, there's a law change with Citizens. If you have an admitted option like from American Coastal, and the American Coastal option's within 20% of what Citizens offers, you can't go into Citizens. So they're trying to disincentivize people from even going into Citizens. They want Citizens to be depopulated. So Citizens is going to have about 1.3, 1.35 million policies by the end of the year. They're currently the largest insurer in the state. Not a good sign for the market. It's the state market for wind. And Citizens is not sort of a solution really either, because a lot of times people don't realize with Citizens, if there's a catastrophic event in Florida, say multiple cat events, and Citizens can't meet the obligations of their policyholders, meaning they can't pay the claims, they run out of surplus, they run out of reinsurance, they have the ability to surcharge every Citizens policyholder in the state of Florida up to 45% of what you pay in premium. So say you pay Citizens $1 million, and then we have a couple bad storms next year, they could ask you to pay $450,000 more to pay for other people's claims. So there's always that threat looming over your head as a Citizens policyholder. Again, hopefully that never happens, pretty unlikely, but the truth is that it could happen. So that's something that you always have to consider with Citizens as well. So we'll look at Citizens, we'll obviously be evaluating American Coastal, we'll be looking at a loss limit option, and then the issue right now with other admitted options for you guys is that the other remaining admitted carriers that do business in Florida, they won't give us an option for this property because the insurable value is too high for them at this point. So Heritage is one that we begged and pleaded with last year to give us an option, and they passed. They said, it's a bit too much for us right now. We don't have the capacity, but we're going to look at it again next year. So we always will resubmit because underwriting criteria changes from year to year. Frontline is another one, but unfortunately they're capped at $35 million in insurable value. So they won't write anything over that at this point. That doesn't mean that it couldn't change in the future. We'll still submit it to them regardless. There's a couple other programs out there, the ones that I mentioned that are sort of in their infancy, that are just coming into the state right now, that are evaluating risks. We're going to submit it to those as well. We can't make any guarantees that they're going to give us an option because they're so new, but that's the beginning of potentially the market improving as those companies start writing more business and gets us into a situation where we might be able to get some other competing carriers involved, and that's when you can create kind of a better competition scenario. So we're trying to do that between American Coastal, Citizens, loss limit, and any other options we can get in the admitted market. So we're going to be full court press working with everything that's out there available to us, trying to create a situation where we're fostering and leveraging these quotes against one another to create the most effective competition for the association so we can get the most favorable rates, terms, and conditions within the context of this market that we're dealing with right now.
Timetable.
So you guys have a renewal in the spring, so we actually start sending everything out 120 days prior to the effective date is the earliest that carriers will submit it. They don't actually release formal quotes until 30 days prior to the effective date. So we'll have indications sooner than that in terms of where we think things are going to be falling with American Coastal. We'll have an early indication from Citizens as well, probably more like 45 days prior. The loss limit indication we can get probably sooner than 30 days as well, but it will be about a month prior to the effective days when we have the formal proposal in hand.
Which is also the same day payments due?
No, not necessarily. No, you don't
Okay.
have to pay. It doesn't have to be in conjunction with the effective date. I mean, because we know a lot of times folks will finance. Sometimes there's accounting things. Some people have third-party property management companies. So as long as the payment generally is within like 10 days of the effective date, it's fine. It doesn't have to
John West
coincide.
has his hand up.
What's our effective date? Is,
Just a minute, John.
John, do you recall off the top of your head the effective date? I know it was March
10th.
March 10th. Yeah.
Okay, yeah, the payment is the 7th.
7.
March 7th. Okay,
Seventh.
yeah. I'm
Okay.
sorry. I know
Thank
it was
you,
early
John.
March. Yep. So
So a month before that is
Right.
when you would have any,
correct. Yeah, early February.
and
we
when,
would have.
how long before March 7th do you have to send us the full bill? Like the whole, you know, we know exactly what the whole bill is.
We would have everything within 30 days prior. We'd have the
Yes.
proposal, but that would be the time that you guys would deliberate and digest everything and make a decision on what option you want to go with. We're trying to give you as much time as possible to, get everything in your, in discussion amongst the board to decide what direction you want to go.
I'll get to you in a minute, John.
Yep.
I have a question.
Yes,
When
sir.
we're insured for 93 million
Mhm.
this year, right?
Right.
Now, what's the deductible on that? Is it 10%? So if we had a storm, we're gonna pay the first 9 million anyways?
Basically, correct. Yeah, per building.
If we
Yeah,
insured for 10 million, then we would only be covered the first million.
correct.
Okay.
Right. Yeah, you got to get through your
Clarify.
deductible first, and then it would be over and above the deductible for the next 10 or 5 or 10, depending on what loss limit we do, and then thereafter for wind. We're talking about wind only, because you would still have if we did a loss limit, you would still have coverage for the full 93 million for all other perils, right? All other property perils, fire, internal water damage, vandalism, lightning strike, like those types of perils would be covered to the full limit. You would just be limiting the wind damage to a lesser amount. Basically sub-limiting a peril, if you will.
The deductible is based on the amount of the claim or
No,
the
it's-
property?
it's not-
Property that you're insured for.
It's
You're insured
based
for
off of the
93
insurable
million.
value of the building, right? You're talking about like a
9.3.
loss sustained deductible,
Okay.
a little different,
You would
yeah.
have to pay the first 9.3. But
Right.
if we only had 10 million, we'd only be responsible for 1 million. So with the 1,000-year storm, what was your figure on that?
I'd have to bring it up real quick, I can find it.
11.1.
Yeah.
Was that the 1,000, John?
Yeah, it was 11.1.
Yeah,
Okay.
that was 1,000.
Yeah, and typically people they'll look at the 250 for the purpose of a loss limit, or they'll take an average of the three. So we could do, either whatever is the most comfortable, but I think you're definitely within the realm of even a 5. You could probably go a 5 based off of the return periods that we've seen.
So we would have two different deductibles, one for the wind and then one for all other.
Yeah, all other perils is typically, I think yours is 5,000 and then maybe 10,000 for water damage.
What if we have a windstorm that causes a fire?
So there would be an all other wind deductible, non-named storm related is typically how we set it up. So the all other wind would usually be like $100,000, $50,000 to $100,000, just a set amount, versus the named storm, which would be the 10% or the 5%, however it's set up by the law. The loss limit carrier would be different than American Coastal. American Coastal will not do a loss limit, unfortunately. We can't get them to do it. We'd have to go to the excess and surplus lines market to do a loss limit.
Okay, I think it's important for John to bring up what our lawyer said.
Yes.
Can I
Everybody should have a copy of the statute.
Based on the statistics we have,
Hold on, John.
potential loss, 1,000 years, et cetera, and our value, are we that far out from all of our other associations that are around us? It seems to me we'd be a cash cow when we've got, $93 million as a value, but potential loss at 11 million. Why wouldn't that be something that insurance companies would jump on versus some of these others? Are they smaller or larger?
So your question is about if insurance companies would be willing to provide the loss limit? You're saying,
No.
yeah.
No, my question is is our condominium association based on the statistics of a 1,000-year potential loss
Right.
that much higher than the other condominium associations around us? I mean, that seems to be a, pretty good deal when you're.
Yeah, no, I mean so John, it's based off of variables. It's based off of geographic location, age of construction, type of construction, age of the roofs, opening protections, claims history. Basically, those 6 variables is what they look at, and they take those same variables and they plug them into their software models. And basically, the 250, 500, and 1,000 are connected to a catalog of named storms for the past centuries, essentially. And they run, like, imagine the spaghetti models that you see. They run those plots in a randomized way, and that's how they come up with the probability of that damage amount based off of those other variables. So it's a very actuarial tool that's used. There's a lot of probability and statistics involved with it. I mean, I'm no expert in it. I mean, we rely on the underwriting community and reinsurers to kind of run those. And there's 2 third-party companies that run the models in our industry, and that's who the whole industry relies on for these numbers. But again, note it is a model, so it doesn't mean that you can't sustain damage beyond what the model says. It's just a basis that the industry uses, and we're just trying to come up with in this market, because it's such a difficult market, any innovative way or outside the box strategy or design to come up with a more favorable, cost-effective program, at least in the interim. I don't think a loss limit is an effective tool for the long term necessarily, because when the market softens up, we're going to get back to normalcy with the rates kind of getting back to where they used to be. But at this point in time, we're just looking for an interim bridge to get us through this very difficult, turbulent time in the market, so we can have an alternative that's not as difficult to swallow for everybody.
Joe.
Are we that much different than the other?
I'm sorry, go ahead. Go ahead, John.
I don't understand. How do we compare with the next door neighbor over here, or Ironwood, or somebody like this? But next door to our condominium association's another one very similar to us, with a lot of buildings spread out over a lot of areas, and with the cement block construction, etc. Are we more of a loss potential or less of a loss potential?
So I think because the risk here is spread out, with multiple buildings. I mean, in my opinion, I think the PML is going to be a little bit less versus a one singular location like a tower or a handful of mid-rises or something. I think the geographic location is helpful. I mean, you're not right on the coast, so you're going to have a little bit of a buffer relative to the wind damage. So I think it's more favorable than some other comparable communities. But I mean, with other communities around you that are similar in size and scope, I mean, they're going to be similar in their probable maximum loss as well, if all the variables are the same or comparable. I mean, if the age of construction's a bit newer, maybe some others have impact glass or shutters, all the buildings have that, they're going to have a better run on the model than you would.
Can we hear from John?
Yeah.
Joe, can we apply for a senior discount? What was the question again, Steve? I'm sorry.
Go ahead, John.
Oh, we talk about the statute? Yes, okay. Excuse me. In talking with Dan, and as Joe has brought up, I think I did previously, excuse me, the word adequate is the key here. Of course, it's coupled with our documents that say
Replacement value.
It says or insurable value. There's an or in there too.
And of course I would never allow the board, or I would never advise the board, that's a better statement, I'm sorry. I would never advise the board to go this route of lower wind limits without full support of the owners. I sincerely believe that if we conducted a vote, and we'd have time to conduct a vote before March 7th, and having the owners tell us, this is what you want to do, who's going to come after us? Is the state? I don't think so. They wouldn't even know. I mean, it's something we should consider. At least I'm not, you could say, John, you're circumventing the law. And yeah, I am. But it's realistic times. A $1.4 million premium versus an $800,000 premium. Who thought we'd even love the $800,000?
Yeah, right, exactly. I mean, that's a good point. I mean, and it just gets to the fact that we're talking affordability of insurance, and interestingly, when you look at this statute, and I've talked to I work with a lot of association attorneys, that specific section, the preceding text above that section talks about the legislative intent of that section. And that's rare to see legislative intent actually narrated out in a statute, and it talks about creating an affordable marketplace of insurance, which is not something that we have. We don't have that right now in the state. So I think to be able to have some interpretive flexibility on what adequate property insurance means, I don't think the legislature, based off of how it's written now, in my opinion, would not condone what's going on with loss limits right now. And I actually have a couple attorneys that, I have a client on Longboat Key that did a loss limit last year, and their attorney was involved from the beginning, and she wrote an opinion piece in agreement with the fact that you can do a loss limit and it's permissible relative to what the statute says.
Can we hire her?
Yeah. I can give you her name for sure. I mean, they're in downtown Sarasota, but
Get a copy.
An opinion for what? Like, where does that go?
she wrote an opinion to the board because the board wanted to have.
That association.
Yeah, that
board.
specific association. So their attorney, I was involved at the beginning, explained to her what we were contemplating, and then she wrote them a letter basically saying this is something that she feels they could do in accordance with, the statute.
I mean, John Haggerty, this is Barbara. If I read the lawyer's response to you, it's our declaration that's the problem, not the Florida statute, correct?
Well, it's a combination, but yes, and the statutes say the most stringent, the most conservative always has to be accepted between the statutes and the documents of the declaration, unless it's a federal case. So, yes, that is an issue.
Yeah,
but if the owners can't vote, the owners cannot vote, or the owners could vote to amend the documents. But when you amend insurance provisions, you must receive the approval of all mortgage holders, which is impossible to get.
Oh.
Well, one thing, John, I'm looking at the section of the docs, and I was reading this last night, and when it gets into, it talks about, for the full replacement cost, or full replacement, and then it says, or insurable value thereof. So, if we're looking at an or situation, again, this is getting in the legal realm, I'm just being interpreting here, saying, okay, full replacement or insurable value. So if we're just kind of not looking at for the full replacement and just read that as or insurable value, and the beginning section talks about the association shall obtain and maintain fire, wind, general casualty, etc., relative to the insurable value, it doesn't give you any guidance on at what level. So I was looking at or and looking at that as a potential out relative to an interpretation, meaning favorable interpretation of potentially doing a loss limit. It's not all said and done. We've got to get the option and see if it makes any sense. But we still want to be able to pursue it and just show you that option in the event that it looks much more favorable, versus a full limits option with American Coastal or with Citizens or whomever at that point is available in the market to provide us with an option.
John, do you know how many mortgage holders we have out of the 558 units?
I can find that out for you. We do the certificates of insurance, so I can tell you. Yeah.
We've already tried that, we never got them all back. Why did we try that? I forget why we tried that, contacting the mortgage companies.
We did, I remember.
When we had a clarification of the documents that were miswritten by
Oh, that's right,
the lawyers.
The lawyer messed up.
It was a requirement for flood insurance.
Yeah, to do with flood insurance,
There's
yes.
a possibility, like you said, that there's that company that has a $35 million loan.
Yeah, Frontline.
Is there a possibility of stacking 35 here, 25 there, 15 there that might be beneficial for the rates?
Unfortunately, no, because it's all the same named insured. So unless the association broke into separate legal entities with those different values, they wouldn't do it. Yeah, that would be the only way to do it. Yeah, but I see what you're saying. I mean, that's a creative way to think that they would do
Because we could
it.
take villages,
Right.
like maybe combine two villages.
Exactly, yeah. Right. Other than that, but then the issue we would run into with potentially doing that, where technically they would fit the guidelines. Say, okay, well here's 35, here's 35, here's 35, whatever. They might say, well, we still don't want it because it's what they call PML aggregation. They don't want that much exposure in one spot. So then they may say no anyway. And again, I'm just projecting as to what I think they could come back and say. It was a way to decline it. But some carriers do that. If they have too much risk in one area, they just won't write anymore. Like they'll put a moratorium on a zip code because they're like, oh my God, we're maxed out for the zip code or something. So we could see that as well.
I think we have got to keep in mind getting a mortgage for people that are buying in here too, because some of these banks are looking at the insurance, the roof, everything else. I just had a friend of mine that had a decline because of the fact that the association had not replaced the roof and was having insurance issues because of it. That's something I don't want to see us screwing up the future. We've already got our mortgages, but there people are going to be buying in here also.
Well, right now, I think that's the least of our concerns. We've got to worry about how we're going to afford to pay insurance this coming year.
Excellent point. Excellent.
Yeah, and just John, I'll say on the loss limit, since we have a number of clients that have done that since last year, basically, there's been no issue with mortgage holders with a loss limit. Nobody's come back and said anything that it's an issue at all.
Thank you.
Yeah.
Marv, you have any questions?
The earliest days that we'll have an indication of premium, you said you start doing this 120 days out, that's around the 1st of November.
Yeah, that's when we start sending it out to the markets that will accept it, and then some markets will accept it at 90 days, and then Citizens is a 60-day submission, so we have to wait till the 60th day point for Citizens, and then Citizens takes about 25 days in underwriting.
Prior to that, we should have some kind of indication between November 1st and December 31st.
We will hopefully have something. I can give you a loss limit indication likely. I'll probably piecemeal it just that way we're not waiting until 30 days prior, but I'll start everything we get. I'll send whatever piece we get to John and let him disseminate that accordingly. But yeah, I mean the loss limit, I think we can get a good indication on that earlier rather than later.
And what you're thinking about that, you're thinking is that we will get a decent kind of reply back on that?
On the loss limit concept?
Yeah.
Yeah, I think so. I think based off of if American Coastal gives us the worst increase that we're anticipating, and basically the premium almost doubles, I think a 5 mil loss limit with full limit X wind, meaning all other perils other than wind, will be less than that. I do.
And who would the company, would it be the same company?
Less than what?
It would be less than American Coastal giving us like a hefty increase that we're anticipating, like 50 to 70%. But the loss limit will not be an admitted company. The loss limit will be excess and surplus lines.
Yeah, well, what would the, 5 million is one thing, but do you have any indication of what a 20 million would be?
20 million for wind?
Yeah.
It would be more than American Coastal would be. I can tell you that right now. The lower the loss limit on the wind, the closer we're going to get to having a more economized option. If we go to 20 million on wind and then full limit X wind, we'll be more than double of what American Coastal would be. We'll be above that. Yeah, there's going to be a breaking point. Well, because
correct. You not indicate to me though, and maybe I misunderstood you, Joe. That if we were down at 10, the premium wouldn't even increase. Maybe did I misunderstand you?
Yeah, I'll have to look back at what I sent you, but I either sent you for an indication of either 5 million wind loss or 10 million wind loss, including all other perils coverage through the full insurance value. And I'd have to look back at what I sent you. But yeah, it was a fairly substantial, it was under. I think it was between like 750 to 850 or something is what I'd given you the indication. But I believe it was either for 5 million wind loss or 10 million wind loss. Anything above that, it's not gonna make sense. Yeah.
And when do you need to know our answer by as to how much?
We're going to base it off the PML, the modeling, so we'll look at it. We can show you options. We can show a 5, a 7.5, and a 10, and then, let you guys decide based off of the risk tolerance factor. But I think between
That's back now we're talking the December, January time.
Yeah. So I mean, once we know it's going to be one of those three based off of the return periods on the modeling. So at that point, you can decide what direction you want to go. We might get a 10 back. And the 10 with the full limits X wind versus American Coastal renewal, it might be like the same premium. So why would we do that? And then we go down to 7.5 and a 5. That might be where we start to see the swing on the premium reduction, and then it might make sense. But then of course you have to weigh. Well, do we want to go in a situation when we're basically taking on $80 million in wind self-insurance on your own? And that's always the debate that people go back and forth on. for loss limits, is that, yeah, you technically, you're getting a substantial savings, but you're taking on a significant amount of risk. It's almost like a secondary deductible.
But that risk is going back to the 1,000-year storm.
Correct,
Yeah.
right,
Okay.
right. Which doesn't necessarily mean it could never happen.
I get
I
you.
personally agree it won't happen ever here. I could not imagine a scenario where you're gonna have $80 million in wind damage. It's just unimaginable to me. But yeah, I think it's still something that you have to grasp with and, you know, take into consideration when you're making that decision.
Could I get back to?
Question, Joe. Have you talked to anybody that has gone out and got a line of credit as their insurance? I.e., you know, we buy $10 million from you, and then we go to a bank and get a line of credit for $80 million that and never use it.
Right.
But have it there, and we would have coverage according to my feeling for full bank.
Yeah, so with what you're describing as a self-insurance fund, which associations can do, but you have to be in compliance.
Yeah, well, I'm buying 10 million.
Right, I hear you, John, but when you read the statute, they talk about self-insurance, right? This comes up often, and there is a self-insurance fund. You can go that direction. It's an association or a group of associations can do it, but you have to get it approved by the state, and you have to be in compliance with the commercial self-insurance statute in Florida. And you will need an attorney to help you set up the self-insurance fund, and you will need to fund the self-insurance fund as well, and likely have to get some level of reinsurance as a backstop to it as well.
We would have to fund it?
You would have to capitalize it on the front end, correct, to create the mechanism so you have a level of self-insurance. I think the statute actually mentions the 250 return period, the 250-year return period for the particular exposure.
But if it's a line of credit, that doesn't mean we're funding it.
You have to be in compliance with the self-insurance statute. So I mean, I'm not an attorney.
So we're really not eligible for a true line of credit.
The line of credit's that's a different animal, and that
Right.
wouldn't be in compliance with the commercial self-insurance statute
Okay.
in Florida. That's the only way.
It's just, it's gotta be renewed every year or whatever, that's not.
No, but we can't use it, take advantage, he's saying
do
you
it.
can't take
Yeah.
advantage of it anyway.
So the other issue with the self-insurance fund, or what John's talking about, is that we don't know if banks would accept it. That's an unknown. So we don't, our company represents over 1,000 associations in the state. I don't know of a single association that's ever pursued self-insurance. It comes up a lot in hard markets, don't get me wrong. Everybody's like, oh my God. I have one on Longboat where we've been on a conference call with their state legislator, like they're trying to get the ball moving, but everybody's like at a standstill because nobody knows how to do it, and they have to pay for it, they have to hire a special attorney. There's a lot of things that needs to be sort of vetted out for it. And by the time people start getting to that point, the market starts to soften up, and then everybody forgets about self-insurance again. So at this point, I'm not aware of anybody that's done it.
I wanna make sure I understood what you said about premiums, and I'm
Yeah.
not sure I followed you. So when you said that we could put a limit in,
Right.
and the limit could make it, the premium higher than what the insurance company that we're talking, I forget their name.
American Coastal.
American Coastal.
Right.
Right. Now, are you talking about American Coastal's projected premium for next year?
Yes,
Which
right.
is theoretically 50-60% more
Yeah,
than that?
correct, right.
So you're saying that we're gonna get up to that level somewhere no matter what? And
Yeah.
that this year's premium is a minimum? Am I hearing that?
Right, I think where we are now, John, I don't know if you remember what the exact premium was, I don't have it in front of me. But I think if American Coastal say they come in and they're over $1 million in annual premium, which is a real possibility.
We're 779.
779, okay, so I think if we were to do a $5 million wind loss limit, that companion full limit coverage for all other perils in the excess and surplus lines market, versus American Coastal would say 1.2, 1.3 million, whatever crazy the number they come back with, we would be in the range of like 750 to 850 approximately. And don't hold me to that, I'm just kind of spitballing it. But I do think there would be at least a couple $100,000 of savings on the loss limit option versus the American Coastal full wind limits.
Versus the higher number?
Yes, sir,
right?
yeah,
The
exactly,
higher
yep.
number. Question number
I
two.
figured that with our current budget that we have proposed, or will have proposed, if we were to keep the premiums at the, say, the 800,000 level, it would be $1,000 a unit savings to our owners.
And it sounds like that's too
Okay,
little.
and John, we would send something out for the owners to vote before
Yes.
or with the, budget.
we have to have further discussions about the
Yeah, I understand.
ramifications,
I understand it.
you know, and everything else, but, you know, I really think it's an option.
Okay.
I'm hearing some things about the insurance companies not paying their claims.
Yeah, you correct. Yeah, there was a big article right up in the, I think the Wall Street Journal and the Washington Post about specifically Heritage was one. Forgot who the other ones were, but yeah, you're absolutely right. Unfortunately, some of the admitted markets in Florida that are regional, maybe not as strong financially as some of the AM Best A-rated companies out there, are having issues with, you know, there has been allegations that the adjusters were changing their reports. Their people are just not getting paid. It's creating a situation where a lot of insureds are hiring public adjusters, they're getting lawyers and things. So yeah, it's true, unfortunately. What you're hearing is pretty accurate. And it's mostly related to the Florida-only carriers, the admitted companies, not the strong AM Best A-rated players. So yeah, we're hearing the same
And are
thing.
we talking to only a Florida rating company?
We only have it to one.
When you say,
Well, I want him to answer.
so you're talking about the one that we're with now?
Yeah.
So American Coastal, they have other risks that spread out in the southeast portion of the United States, but they are heavily aggregated with coastal risks in
Are
Florida.
you hearing things about them paying claims?
Yeah, there's some issues with them. I have a client that's having some big issues with American Coastal right now. They're down in Rotunda. It's a big Ian claim. Yep, and they have a public adjuster and a lawyer.
Is that part of the Hurricane Ian? Was that?
It was from Ian. Yeah, they're having issues with American Coastal.
Yeah, that's the part that bothers me.
I know, yeah.
We insure for 93 million and then we have $50 million worth of damage, they're not gonna pay out anyways.
Yeah, I mean, the only advantage of the admitted company is that you get $200,000 through the FIGA, the Florida Insurance Guarantee Association. If American Coastal became financially insolvent, and they were just like, we're out of business, which is a real possibility because it's happened before in the state, you would get up to $200,000 per unit as remuneration for whatever left. So if you have a huge claim, you get $200,000 per unit as the max that the state will reimburse you.
Per unit, you mean per owner?
558 units, or are you talking about buildings?
We're talking about per unit, so we can do the math on it. So that would be the advantage of having an admitted company. So is it 558?
Yeah.
I have to do this on my calculator, sorry. So it's well over the insurable value. So it's
Under
over
10 million, yeah.
So that's the advantage, even though that there's these negative things in the press and things about admitted companies, which is all of it's correct, you still have the state backing there for the FIGA, right? So if you had some issue where you have a $50 million claim and they're starting to lose control and, you know, running off the tracks financially, the state would come in
So
and
is that
take
an
over.
alternative for your client right now that's having trouble?
What's that?
Is that something that your client who's having trouble getting paid will be able to do?
No, because American Coastal is still in business, so they're not going to get, they're still
So
solvent.
they have to go out of business for that?
Correct, they have to be financially insolvent, yeah, correct.
Plus the fact you still have a chance to be assessed by citizens to pay in a horrific storm, wouldn't you?
Yeah, if you were with Citizens, you have that surcharge probability hanging over your head all the time, right? Every storm season, you're like, oh my God, are we gonna get hit? And like, say like a storm, you know, goes up through the Panhandle or hits, God forbid, the Tri-County area on the East Coast, Citizens will do they'll do an assessment because they'd be wiped out so fast because the Miami-Dade area is so dense and there's so much exposure over there from a property standpoint that everybody that has a Citizens policy would be getting a bill, you know, on top of what you already pay. So that's not a fun thing to have to deal with.
It's not something we wanna.
Yeah, nobody wants to deal with that. Yes.
I have two questions. I've been paying insurance for a long time. Why do we have to pay the damn thing up front? Why can't they give us 6 months to pay it?
So some carriers can. Yeah, I mean,
Yeah, I
some
know.
carriers have installments, but not
Yeah.
all. You know, in the absence of doing, you know, an upfront pay in full, if there's no installments, you can finance it. Now, I will tell you, the rates, for anybody that follows the news and rates, they're terrible. The Fed's raised the rate like 10 or 11 times in the past couple of years, so I think the prime rate is like close to 9% right now. So we would get a finance agreement, it would be basically the prime rate, 9%. You know, you could have the option, I think it's a 25% down. Sometimes we can push that to 15% down, and then you can pay, the association pays like 10 equal installments or something, or 9 or 4 or 6.
How about just
$300
three?
to the owner's bills.
Yeah, I mean, the interest rates are just terrible right now. So it's not an option that any association that has the ability to pay in full generally will not want to finance because of the interest.
So American Coastal is not gonna finance us for 6 months?
They don't offer any type of direct billing, anything like that. A couple of carriers do, but they're ones that have declined, unfortunately, in the past. Like Frontline does. You guys are too big right now for them. Heritage, which looked at you guys a lot and they really underwrote you guys last year. They decided to decline. I'm pretty sure Heritage does have some type of internal installment plan. But I mean, they have it again. They're looking at it again, so we'll see if they will step up to the plate.
Well, if we lowered that limit, they wouldn't touch us because of the...
Heritage had more issues just with like the age and the aggregation of how much insurable value it is, and they were questioning some of the roof ages and things like that. So they actually rented up the chain to their chief underwriting officer, and they ultimately declined it. But we tried hard to get them, because that would have been great, because then we would have had a situation where we could pit them against American Coastal. That's what we were trying to do, but they declined. But they did tell us to send it again, so they're looking at it again.
When you submit those, do you submit a record of what we have had losses for over the last, 45 years?
Yeah, they have all that information. Yeah, they have all the losses.
But our losses have to be minimal.
Yeah, that's just one part of it. You're right. So like I mentioned, they look at not only losses, it's age of the construction, geographic location, age and conditions of the roofs, opening protections, type of construction. Those are the other factors they analyze. But yeah, claims is huge, because if you had like an open Ian claim, guess what? Nobody will give you an option. You're stuck. All you get is the incumbent carrier to give you an extension, and that's it. By law, they have to give you an extension until 90 days post repairs of whatever existing Ian damage that you had. So thankfully, you don't have an Ian claim, because that would be a big impediment to us remarketing you guys and getting you a better option. It's a big issue right now in the
I had a
marketplace.
question about the roofs. Okay, because you said, I understand that with the state insurance, you need to get the roofs inspected, and it's $100 a roof. But I don't know how many roofs we have, and it doesn't sound like it's a lot of money to me, especially.
25.
Yeah.
So if Heritage or whoever is interested in the condition of things, would we be better off doing that anyway for everybody, or does anybody?
Yeah.
So we already have the wind mitigation inspection reports on file, which were done when the roofs were either recoated or redone. So they're usually done in conjunction with, there's a permit pulled when a roof is redone for some purpose or component. So we already have all of those. So they look at the age, the original age of the roof, and that's how they base their underwriting decision. A lot of times, if the roofs are 15 years or older, way less favorable in the eyes of the marketplace. They don't want anything to do with it. A lot of them will not. Some of them will give you a quote, but they'll give you actual cash value for your roof, not replacement cost. So that means the cost to replace your roof less the physical depreciation of 15 years, which could be you get 50% of the cost of the roof. If it's newer than 15 years, then carriers are getting more interested, and they're wanting to step up and look at these risks. So that's a big factor in what they look at, the age of the roof and the condition of the roof. And they have computer software where they can look at, sophisticated, very clear aerials as well of the property, and they can look at the conditions of the roof that way. There's some companies that do some really amazing work on that front too. Yes, sir.
We just had a new wind mitigation report.
Yeah.
Ours is current. It was just done a couple months ago.
For every building?
Yes.
Okay, that'd be great. John, can you send me that?
There's photos.
Yeah. I was just going to say the same thing. We just got it. I don't think Cynthia sent it to you yet. But,
okay.
We have brand new windmills.
Great. Yeah, I'd like to take a look at those. So when you can, have her send it to me. That'd be great.
Yeah.
John, are they available for the homeowners now to give to our insurance?
You broke up a little bit, sorry.
Is that?
There's a summary page.
Is the?
Yes.
It is available?
Yes.
It's on the website?
Yes.
Yeah.
Oh,
Yes.
okay.
Never mind.
Never mind.
Yeah, your personal lines carriers will want those as well. They usually,
Yes.
personal lines carriers want updated wind mids often. So.
Any other questions? Anybody online?
Well, what about moving forward? So, are we going to just discuss that?
We're gonna have to take it to the regular board meeting and
Okay.
discuss it there.
Yeah, that'll come up on the October meeting. Obviously, be prominent.
I got a question for you. What haven't we asked you that we should ask you?
Good question.
I think you're asking really good questions. I mean, I think most boards right now are just, concerned, and residents are concerned about rising costs, because, condo associations, it's changing. Luckily you guys don't have the SERS issues to be dealing with, with the buildings that are 3 stories or over, but still, capital improvement projects, just general costs of inflation are increasing costs. dues are going up in conjunction with insurance, so everybody is concerned right now about increasing costs for just basically living in your condo, really not anything else. And you're not alone. I mean, I deal with this all the time. I mean, I represent a lot of associations, and it's the same recurring issues everybody's concerned about. Insurance is front and center right now, as you're well aware, so we're doing everything we can, in our power to create these alternative avenues and options to give you some other option, because it's, it's very easy for, agents now are leaning into that hard market narrative and are just coming in and saying, hey, here's your only option, the market's terrible, there's nothing else. Well, I don't like that. I don't like not having options in life. I like people bringing me options so I have a choice, and that's what I feel my job is to make sure that we're doing that and leaving no stone unturned. So rest assured that that's what we are doing.
Well, we appreciate it, Joe.
Sure.
Can I say just one thing, and I don't mean this in a negative fact. I mean, that's one of the reasons that we came to take a look and make a change from a company from Brown that was around for 15 years because their service deteriorated. But one of the premises, Joe, was the fact that we would have options, and unfortunately there haven't been.
So far.
I mean, all you've been able to bring us is ACIC or Citizens since we've moved.
Yeah, I know
Is there any realistic anything else out there?
Well, I mean, as we discussed, we're ACIC, at least we're going to be anticipating a renewal from them. Citizens will get the indication, that's 2. If there are any other admitted markets that at the point in time of the renewal in the spring that are willing to provide us an option, we'll have that. And then the loss limit. So potentially 4 different options we'll have to look at. Worst case scenario, if there's no other admitted market, then we're talking about 3 options.
Unfortunately, I only hear 3 because there hasn't been that other one. But okay, I hope I'm wrong.
Well, like I said, John, it's early. I mean, the good news is there are new markets that exist, and they created themselves and they started writing business in conjunction with the new legislative reform. So they don't have any issues, no downstream exposure related to litigation, related to any additional claims being filed, because they've never done business here in the state at all. So they're just now starting, and they're being very careful from an underwriting standpoint. They're only writing in certain areas like in North Florida right now, and they're just kind of like taking a very measured approach. But over time, they're going to start opening up more and more and more, and then maybe this time next year, they're going to be front and center all over the state for a lot of condos. But right now, they're being very narrow in their underwriting. They only want a specific type of a risk, a specific range of insurable values. All of that is subject to change. That is never in stone. It's all contingent on the market. So once we start to see them pick up some business, they're going to be winning it from other carriers that have been increasing rates, and it's just market economics are going to come into play, and there's going to be competition again. So we're slowly starting to get there. But just, nobody expected that with the legislative reforms that it was going to be like an immediate fix, like flipping a switch. It's a complicated marketplace, a lot of interconnections, and it takes time to heal, but we are in a much better position than we were 24 months ago, 18 months ago. We're slowly getting there. It's like we're on the the top of the roller coaster, that point where the roller coaster just goes straight for a second and then you that's kind of where we're at. I don't like riding roller coasters a lot, so my kids do. I hate it.
Our biggest concern is probably the effect on unit owners having the ability to pay such a large increase.
Right.
And that ends up, people getting behind in their payments, and then we start taking legal action.
Sure.
People's it's this $200 increase a quarter just at the middle
Yeah.
range.
No, I totally understand.
And that's a lot to ask people all of a sudden to start paying extra.
Right.
And they're on fixed incomes.
Of course, yeah.
Their incomes don't go up as much as the insurance rates do.
Well, that's the problem right now with condos in the state, is that people that have bought, lived in their units for maybe decades, it was a different snapshot of time, different marketplace, and now things have progressed and then costs are going up, but people's incomes haven't changed.
Right.
So it's a huge problem, and it's not going on in a silo here, it's going on everywhere. And it doesn't seem to be, stopping anytime soon, other than the insurance, just other inflationary costs are going up. And then the insurable value increases are another thing that we have to contend with as a condo. Every 3 years you have to get a new appraisal. That's the law. So what have we seen for the past 6-7 years? John, you probably haven't seen an appraisal go down, probably, ever, right?
No, ours went from 79 to 92 million.
Right, and then the appraisers are just pointing to cost of material, cost of labor, inflationary increases, and all that's accurate. Construction is going up, and now with the immigration law change, with people not being able to get certain workers in different, subcontracting industries unless they're legal immigrants, which, it is what it is. It's just the new law. They have to do E-Verify through the federal government, and a lot of folks are having trouble getting workers. So they have to get other workers to come in and pay them more. So they're going to pass that cost down. So we're all seeing that, unfortunately. Yes, sir.
You've seen our documents, and do you think that in order for us to do a loss limit, that we'd have to change our documents? Obviously the lawyer thinks we aren't, but we have to.
Yeah. I mean, I guess I wouldn't totally disagree with it, but I think you could look at it and with that the or word in there, you could make an argument for you're interpreting it as you have a choice of full replacement or insurable value. So if you took out full replacement and just inserted insurable value alone, then I'm reading that as I can choose whatever values I want as long as it's based off of the insurable value that's on the appraisal. So it's a little nuanced there, but that's my opinion. But I'm not the association's attorney, so.
Thank you.
Sure.
Yeah, my thought on that is if we need to replace insurable value, probably not a whole lot of us will still be around anyways. If we get hit with a storm, it does that.
Yeah, it's unimaginable for wind. I mean, wind to completely the whole place to be 90-some minutes.
I'm gonna wait for the 1,000-year storm.
Yeah, I mean, it doesn't even seem possible. But I mean, with some associate, if you're like, one building and you're frame construction and you're on the beach or something, we would never recommend a loss limit. Like, it's not even in the, possibility. But when you're this far pushed back, you're multiple buildings, it's conceivable that we could, you could get away with it,
I think our owners will go for that. I think the owners, rather than.
I think so.
$200 a quarter is.
A month.
Yeah.
Where did you come up with that number?
She did.
That's based upon.
See how bad paper.
260 is the
Let me
last
finish. So we reach out to our insurer to get what is the predicted increase come next March.
And what would that number be?
They said it would be a range, correct me if I'm wrong, between 50% increase and 150% increase. So the budget committee right now picked a middle of the road. We picked 100% increase. And that's calculating out to be roughly $200.
Okay, that's what I wanted to hear,
Yeah.
because I want to know.
It would be anticipating American Coastal doubling.
Yeah. Right.
Right. Which would put us at like 1.2, something like that, and change.
No, put us at 1.6.
All in. I'm
If it
just
was
talking the
double.
property. Yeah, I got you. Yeah.
Yeah, if it's 100%, it's
Yeah.
1.6 million.
Right.
I think the board has a lot to discuss.
Yeah.
Do we have any more questions for Joe? John, you have anything?
Not at present, thank you.
No, thank you for coming in.
Thank you very
Yeah, no
much.
problem.
Yeah,
Sure, thanks for
thank
having me. Any other questions? Let me know. I'll leave a couple cards behind if anybody
Yes.
wants to talk insurance. Give me a call. I'll just leave a couple cards. My cell number's
I
on
got
there.
one more quick question.
Uh-huh.
I'm gonna check with somebody on these.
Proactively, is there anything that we can look at for the future to get this insurance bill down with some type of value to return on investment type thing? A prime example, if we were to put together some type of a program where all windows turn into hurricane,
Yeah.
would that
Right.
give us
Yeah.
a substantial decrease?
Yes. Yeah. So it would. I mean, unfortunately, the answer to your question is more money spent. And nobody wants to have that as the answer.
Yeah.
But yeah, the answer is yes. I mean, of those variables that I mentioned, when you're viewed as a risk, again, the geographic location, age of construction, type of construction, claims history, roofs, and exterior openings, only 2 of those variables are within your control. Exterior openings, upgrading every exterior opening of every building to impact-rated materials or shutters, and then the roofs, replacing all the roofs, brand new roofs. So those 2 items are hugely impactful for the future, because when things do soften up and more of that capacity starts pouring into the state and those programs get more favorable and bigger and they're growing, they're expanding, when they're looking at all things being equal, older properties, maybe like yours, they're going to want the ones that have the best roofs and opening protections first. And those are the ones that are going to get the most preferential capacity, the best rates, terms, and conditions at the beginning of that process. But yes, to answer your question, those 2 factors are huge for insurers, because insurance it's a business. So the insurance companies are looking for the greatest return on their investments. So if you're an insurance company and you're like, wow, this association has all new roofs and every window and opening is protected, doors and windows, seems like I have a pretty low risk of having to pay out on your behalf, so I think I would partner with, I'm looking at it from an insurance carrier's standpoint, that's what they look at, so, yeah.
Absolutely.
So maybe we should talk about that, Steve, in the building committee.
Yeah.
You know what,
John, if they can't afford $200 a quarter, so they can't afford
Right.
$10,000 for a new window.
Absolutely.
It's gonna be a lot,
I
yes.
know.
Yeah, those are not cheap.
the homeowners are paying for the openings.
$10,000 a unit with the sliders.
Yeah, it's not cheap, unfortunately, impact glass. And then the impact rated doors too.
One of the criticisms of the insurance companies,
By investing 10,000, we get 30,000 back. I don't see that.
I don't see that.
Yeah, over time you will.
All right, Tiffany, got anything?
What?
No, we're good. Anybody? Chris?
one of the criticisms of the insurance companies is that their executives have been paid too much. They skim money off to subsidiary companies. Why hasn't the state done anything about that?
Well, the admitted companies are highly regulated, so admitted companies have to be regulated through the Department of Financial Services. They have to file all their forms and endorsements and schedules with the state, so there is a lot of regulation on the admitted side of the equation. But the excess and surplus lines companies have a lot of freedom and flexibility. They can do pretty much anything they want with rates, their coverages, because they're not regulated by the state. So I'm not familiar with the carrier executive compensation. I mean, I'm sure some of them, probably get a lot, but at the same time, it's it's America, I guess. I mean, you start a business, I guess they do what they need to do, but unfortunately, it is at the expense, in some cases, of the policyholder, especially when there are companies that have gone out of business. It's frustrating to see that, you see, executives selling a lot of their shares and things like that, and then the company goes under, and you're like, well, who really benefited here? It was a handful of people. So, unfortunately, that has happened. We've had a lot of carriers in Florida that have gone out of business, and unfortunately, insureds like yourself, from a homeowner standpoint, you get the bad end of the deal with having to find another carrier, then you're going to pay double. It's just unfortunate. Or you go to Citizens. So Florida's just a very difficult market right now. Very difficult.
Okay, anything else? Anybody?
No?
Going once, going twice? Okay,
Thank you.
thank you, John.
Thank you.
I
Good seeing you.
appreciate it.
Yeah,
good
yep.
seeing you.
Have a good rest of the
John
day.
and I will be in contact.
Sounds good. Yep. We'll talk soon enough.
Feel better, John?
Right.
Yeah, we hope you feel better, John.
Sweetie.